Hello, everybody, and welcome to the webinar on PPPs and project finance markets. I'm Shyamala Shukla from the World Bank PPP Group in Washington, D.C. And this is fifth in a series of webinars jointly organized by the E Institute and the PPP Group of the World Bank to discuss some key areas of interest in PPP. We have here with us today people who have registered from around 80 countries around the world. It's an high estimate, and we have at least with us now, logged in with us right now, at least people from, I would say, 50 countries. We'll get the numbers later on, and it's very exciting having you with us today. And joining us from Jakarta to discuss this topic, we have Gavin Munro, the Managing Director and Head of Infrastructure Finance of Asia Pacific of Societe Generale. And Gavin is based in Hong Kong, and he has been in the space for almost 2 decades doing this project finance in various countries. He's been in Africa, Europe, and now in Asia Pacific. He has many interesting insights to provide to this topic, given his expertise and experience. And we are very privileged to have him here with us today. I'll tell you a little bit about how we will approach this webinar. I'll give you an introduction to the topic. We'll see what's actually happening and what are the symptoms we are seeing in different markets. This will be a very short presentation, followed by more detailed and nuanced insights into project finance by Gavin. And then we will go on to a 25-minute question answer session where all of you will have a chance to ask Gavin while he's there with us captive, ask him a few questions, things you've always wanted to know, and we will have a very good discussion, I'm sure. Let us begin with a very brief look at infrastructure finance and global PPP financing. What you have with you on the slide is a picture of global infrastructure project finance as it has been from 2005 to 2013. You also have the deal count as well as the volumes. And you can see the ups and downs that this market has faced starting 2008. Following the financial crisis, and you can see a little peak there and then coming down in 2012 and back again in 2013, and markets seem to have recovered quite a bit. And what's happening here is that it appears much more diversified in terms of lender profiles, and some dominant banks have emerged from the Asia Pacific region, and the energy sector continues to dominate in terms of sectors. Going on to the global PPP infrastructure investment, this is a part of the larger picture which we saw. And this tells a slightly different story because we didn't see the same increases in 2013, and it has been a steady downward trend so far. Investment as well as the number of projects during the period 2011 to 13 seem to have gone down. Bank lending, as always, seems to continue to dominate the project finance market in PPPs. We have seen some significant bond financings here. If you can see the light blue band, that's what shows the bonds. And now people are also talking about early and less long-term financing, with more permanent and longer-term financing coming in after the construction period. So we've seen some few major changes, and we'll talk to Gavin later on to ask him what it is like pre-2008 and the post-2008 project finance market and PPPs. What's happening in some of the developing countries which have been key players in the PPP market? Are they performing like we expected them to? Have there been changes? We have some PPI data for you from 2013. And as you can see, Brazil, India, and Russia seem to have disappointed. There's a decline in closed projects and a decline in total investment comparing 2012 and 13. On the other hand, Turkey, Mexico, China have seen real increases, and Turkey shows a huge increase in investment. Some major deals closed this year in Turkey. China and Mexico likewise have showed substantial improvements. And what's happening in the developed markets? The UK has once again emerged as the biggest PPP market in 2013. It has shown substantial investments in the transport and social sectors. And these are the kinds of sectors we'd also like to see emerging in many of the emerging PPP markets also. Australia has had some high profile financings during the last year, and we'll talk a little more about this later on during Gavin's presentation. The US is another market which has been showing increasing interest in PPPs, and we see an increase in the number and value of PPP investments here too. Okay, this stopped responding. Sorry about that. Yeah, this was the slide I was talking about, where you can see the picture on Brazil, India, Russia, Turkey, Mexico, China, the increases and the decreases, and the three major developed country markets, where again you have seen some high-profile deals. Going on to project structuring. Project structuring matters quite a bit in terms of being able to attract project finance. And what has been changing here is that it appears that the private sector, the SPVs, seem to like, less of demand risk. There's more of a tendency to go towards availability payments. PPAs, of course, have always been there. And there's other forms of demand guarantees also which are coming in. And we see more of a trend towards these in some of the markets, at least where I have been working in the last few years. And there's also this tendency to take on less construction risk. Nobody really wants to take on too much of it. So the demand and construction risks are the major risks in project are something which the private sector seems to have become wary of. And the government debt support instruments you have seen in major markets like the United Kingdom and the USA, there's more of government support coming in terms of senior debt or subordinate debt, and also guarantees by government. Letters of comfort have always been there in the African market, but you now also see lots of guarantee of senior debt. We'll see a few countries a little later, but you have all kinds of support instruments, all kinds of protections being built into these projects. There have been what I have termed here as innovative structuring, but I was just talking to Gavin, and he says it's more about accepting what is there rather than innovative structuring. It's coming to terms with what is there. So you see a few financings called mini perms, where you have a shorter term initial financing by commercial banks to be followed by with the incentives built in for refinancing after the construction stage is over, maybe say after 5 years, 4 years, depending on the kind of project. And there's also increasing trend towards the use of multiple financing instruments, government support instruments, to make sure that the project finance comes in. To give you an example, the United Kingdom has gone through major changes with PF2 coming in after its initial PFI, and the UK guarantee scheme that I was talking about for senior debt. And I've shown here one example of a project which has been closed recently. I think it was in April 2014, and the government has guaranteed 50% of the senior debt in this project. And not only that, there's this system of availability payments where the Department for Transport has come in, and it's covering any shortfall in revenues that the local the Walton Borough Council might face. So it's kind of it's a protection, it's a minimum revenue guarantee also, and there's also protection in the form of 50% of the senior debt being guaranteed. It creates contingent liabilities for the government, but this is the way we see the market emerging. In the United States also, we have seen the TIFIA coming in, the use of subordinate debt with longer terms. And at the outset, that like the US has actually been using these mini firms for quite some time, I believe. with the private commercial financials coming in at the outset with senior debt. And there's been an extensive use of availability payments in the US also. And this is one example of a project, a recent, not so recent project, but fairly new project. Now we come to India and Africa. These are countries of great interest. Africa is a continent of great interest. It's an emerging continent. In India, we have seen in the earlier slide, which I showed you, that the number of deals and the volumes have also come down. And I was looking at the report on the Asia Pacific for this year, and I could see that there's been a downward trend and it's been kind of steady. And for 2013, I think there are a few explanations. One is, of course, the economic downturn, but that's not been totally responsible for this. India has faced a lot of financing issues as well as governance issues. And unless these are solved, I think it'll be a little bit difficult for the market to pick up. There have been sector exposure limits and then single and group borrower limits, which have been reached with only a few companies actually coming in again and again in different SPVs, and now they can't borrow anymore. And when they go to borrow outside, there have been problems of currency depreciation, and then lack of affordable hedging instruments is also another problem that we are looking at. The governance issues with the coming in of the new Prime Minister in India, there's hope that these governance issues at least would be solved immediately. As far as Africa is concerned, I've just come back from after spending 2 weeks in Nairobi, and I was looking at the energy transactions there. They have quite a sizable number of power sector PPPs, and there's very little traction in the other sectors. And all of these transactions which have been done so far are also heavily wrapped, and then you have all kinds of guarantees and protections, letters of comfort being built in. And the new projects which we see in these countries, some of these countries, are also backed by letters of comfort. So we don't know how sustainable this will be in the long run. Now we'll go on to Gavin. He'll be giving you a more nuanced and detailed and in-depth, I would say, insight into what's happening in the major markets. And I would ask Gavin to focus a little bit on some of the questions which intrigue us all the time, and we discuss this all the time. Has there been a difference in the project finance market prior to and after the financial crisis? What are the kinds of changes you're seeing in risk allocation? Anything else? And how much do you think is the resurgence of PPPs in the UK related to what the government has been doing and the way it has been coming out and making things easier with the guarantee scheme as well as the co-lending scheme? I'm not sure if the co-lending scheme has been used yet, but we can talk a little bit about that. And please do talk about the Indian PPP market. It's a market of real interest to me. I have worked there for many years. And I would like to ask you, um, what would it take for you to be interested in, to feel really comfortable in financing projects in India? As you know, the Indian Prime Minister has said, make everything in India. So would you like to see roads, bridges built in India with investment, which is, driven by you? And how do you see the PPP project finance market in some of the African countries emerging over the next 5 to 6 years? Do you think it is sustainable, the model that they're following now? And what do you think are the markets of most promise among the developing countries? Gavin, over to you. Unmuting.
Thinking of actually starting with is to actually just do a quick run through a comparative analysis of a number of the main PPP markets that I've worked in and am most familiar with, then draw some conclusions from what are the sort of common drivers behind that and why you're seeing different funding structures developing in different markets. I'll also do a bit of a wrap around in terms of what we saw happen after the global financial crisis and then try and answer some of the other questions that you've raised. Looking firstly, so I can try and make this a bit bigger. Yeah. The UK and the European market is probably the market that I'm most familiar with. I spent 12 years running the infrastructure team in London, and without going through all the details there, the essential structure is that you actually see very tightly contractually bound structures where the project entity is largely de-risked, with most risks being passed down to the subcontractors. And then you're actually seeing very highly structured, highly leveraged debt packages put in, where you're achieving about 90% of the overall financing in the debt, and very little sort of cushion for things going wrong. So obviously, very few risks left in the project company. The French took this a step further, and they pioneered what they called the Session d'Ailly tranche, where you could have about 70% of the debt guaranteed by the state. So, of course, it was getting a much reduced funding cost as a result of the state guarantee. Now, the major source of funds in the UK and European market is the major European and international banks. You are also starting to see non-bank financial institutions coming and starting to invest in infrastructure debt, and specialist infrastructure funds starting to be formed, but it's still largely a bank-dominated market. The European Investment Bank is an important source of funding, tends to be more cost-effective than the commercial banks, and they do put in additional support to support the projects that they see as strategic, and the sort of things is strategic European transport projects, the so-called TENS schemes. At the moment, there's limited use of project bonds in the European market. If we then turn to the American market, you're actually seeing similar type of structures in terms of how the project company is de-risked and what sort of levels of debt you're actually getting in. But the US market is actually dominated by bond financing, and a lot of it is tax-exempt bonds. But there's quite a variety of different structures that are used in the US, and it really all depends with what is the most efficient structure or source of funding at the time you're looking at closing the project, because this does change over time. The appetite of investors that play in certain parts of the bond market, appetite varies over time. If somebody's come just ahead of your project with a big issue, you might actually find pricing going up because there's not that much appetite at that time. There's still a significant involvement of banks in funding the American PPP market, but it's definitely smaller than the bond market. The next market that's also quite significant, but is also a very mature market, is the Australian PPP market. Again, similar structures to the European and American markets in terms of the project company being de-risked. But that's really where the similarity ends. The funding structures in Australia are very different, and they are dominated by what are called mini perms. This is where the banks lend shorter dated debt into the project, typically in the sort of 3 to 7 year range. Occasionally, the longest I've seen has been 10 years, but 5 to 7 years is probably where you see most of the maturities. There may be a limited amortization of the debt, but what you're actually taking the risk on is that when that debt comes up to maturity, you're able to refinance that project. So you effectively go back into the lending markets, raise another lot of 5 or 7 year debt from the banks, and use that debt to repay the previous debt. So if you think of a 30-year project, you're looking at sort of 4 or 5 financings along the way. Why do sponsors go for this? It's largely because they don't have any choice. There actually isn't much long-dated funding available in the Australian market. But an interesting development that we've seen over the last few years is increasingly they are putting a tranche of this funding into the US PP market, and there is developing in the US private placement market an appetite for Australian infrastructure assets in particular, and probably international infrastructure assets in more general, as the market gets more and more comfortable with infrastructure assets. We've seen an Indonesian company, port company, raise funding in this market recently. So I think that's probably a trend you're going to see going into the future. But typically what we're seeing in the Australian market, it's not the whole amount of the debt that's being placed in that market. It's effectively being used to reduce the refinancing risk, so that what the project company is refinancing is a smaller amount. The dominant players in this market are the Australian banks, obviously. There's a lot of involvement by international banks. And what Shamala referred to earlier is you're seeing the Asian banks coming forward. Big players in the Australian market are the Japanese banks. When the European banks pulled back from this market about 2.5 years ago with the Eurozone crisis, it was the Japanese banks that really stepped in and filled that gap. But now the European markets are back, and the European banks are now re-entering the Australian market. So we're going to see, I think, more competition in that space. The Indian market is a very interesting market, and we've been looking at a number of opportunities in the Indian market. I think it's only a matter of time before you actually start seeing international banks going in and funding projects in the Indian market. But you're going to have to see some changes there. The project finance market in India has sometimes been described as a hybrid market, in that it's a hybrid between corporate and project financing, and it differs from all the previous markets we've discussed in that basically the project company doesn't actually de-risk and doesn't have as tight a structure as you would see in the European or the American market. And there's also tends to be a lot more support from the sponsors. When you go and speak to Indian banks about funding infrastructure projects in India, very often you will hear quoted, "You've got to choose good sponsors." And what they actually mean by that is that they are targeting and lending to projects where they have a good relationship with the sponsors. They believe the sponsors are trustworthy and reliable and will stand behind those projects. And I think the Indian sponsors actually like this type of structuring. It's actually a lot easier for them. You don't have to negotiate such complex documents that you would see in the European, American, or Australian market. And the sponsors are left with a lot more flexibility, but they do have more responsibility. What Shamala did refer to is that the Indian banks are now starting to get concerned about their levels of sector exposure, particularly to the power sector and the road sector. And we're seeing Indian sponsors now starting to look to international funding markets, trying to build relationships with international banks. But I think they're only really going to start changing when they absolutely have to. As long as they've got a chance of continuing to raise funding in the Indian market, I think they will continue to do that. And it's only really when the Indian banks are starting to say, look, we can't do that anymore, that they'll then actually really start bringing in the international financing. The last market I was going to touch on is the South African market. That's my sort of home market, where I started doing infrastructure finance about 20 years ago, as Shamala indicated. The South African market in terms of the project structures, tended to follow the European market, and probably most closely the UK standard model contract. And the South African market is perhaps unique amongst emerging markets in that it has quite a sophisticated banking industry, which it's actually been able to access. So the market there is dominated by the big five local banks. You can get longer dated maturities, not as long as you'll typically see the European banks doing in the European market, but 20 years is very common, and if you're lucky, you can get up to 25 years on a project. Structures and leverage levels are similar to what you will actually see in the European market. The one thing that is unique about the South African market, though, is that there's a strong appetite from institutional investors for inflation-linked bonds. And this is really a market that the early toll road projects in South Africa actually pioneered, because if you think of a toll road project, all your revenues are linked to inflation. Your tolls increase with inflation every year. So if you can raise debt that is linked to inflation, it's a perfect hedge to your revenue stream. And this was an instrument that the life insurance companies with long-dated inflation-linked liabilities in terms of their pension fund obligations latched onto. And they saw it as an attractive product. I don't think they were particularly attracted to the project risk, but there's a shortage of that type of an instrument in the South African market. The government has issued some inflation-linked bonds, and those are typically used as the benchmarks, but the institutions will actually grab as much of inflation-linked funding as they can. Another important player in the South African market is of course the Development Bank of Southern Africa, which is a development bank that's obviously sponsored by the South African government, and they're very active in their home market as well as in the rest of Africa. And the European Investment Bank has also concluded a framework agreement with the South African Reserve Bank, and they are able to provide cheap rand-based funding, because effectively they can borrow cheaper than the South African government can, being the effectively guaranteed by the European Union. Right, sort of then taking a bit of a synthesis of all of that, I think the real conclusion that I arrive at looking at the nuances and differences between all of those markets is that effectively what sponsors and bidders are doing is they are trying to access the most efficient source of funding that is available to them. These PPP projects are typically competitively bid, so they are trying to be competitive in all areas of the project structure. They're trying to get a low or efficient construction price. They're trying to keep down the operating costs, and they want to have the most efficient and cheapest funding structure that they can actually get. So banks in the European market have been providing that lately. In the American market, it's been the bond market. The European bond market is not as liquid and sophisticated as the US bond market is. But of course, as markets close, then you've got to find alternative sources. And that's effectively what happened with the global financial crisis in 2008. There was a huge pullback at the time. It was actually quite difficult to get projects funded. A lot of banks that had been active in the area weren't lending into projects anymore. And of course, all the bond markets actually closed. The bond markets do tend to be more twitchy than the bank markets. If there's a crisis, the bond markets will close before the bank markets will. But ever since then, structures and banks have recovered. I guess we've got short memories. So structures are starting to get back to where they were, with a couple of important differences. And I think the biggest difference that we've actually seen since the global financial crisis is that the monoline insurance market has disappeared. If you're not familiar with what monoline insurers were, they were effectively insurance companies that would guarantee debt issued by other entities. It was something that grew up in the American market, and they were guaranteeing American municipal debt. So a lower rated debt issuer that was, say, a triple B rated could pay the monoline insurer to guarantee or wrap their debt. That debt would then be sold to investors as triple A, because the monoline had a triple A wrap on it, had a triple A rating. So investors saw themselves as taking the risk on the monoline insurer rather than on the underlying. That market has closed since the global financial crisis. The monolines all lost their triple A ratings, and it doesn't look as though that is actually coming back in any shape or form. The other big difference that Shamala was also pointing out is revenue risk projects, particularly greenfield toll roads, have all but disappeared. And all banks really learned a very painful lesson through the global financial crisis. And I think we all concluded that it's a lot more difficult to predict toll road growth and toll road risk than we'd thought. And this was seen across Southern Europe. You know, the countries that really battled the most, Greece, Ireland, Portugal, Spain. Traffic growth there just dropped completely, actually went negative. Previously, banks sort of felt fairly confident that once you had proven traffic, the growth might slow, but it tended not to drop. Well, that went out the window in the global financial crisis. The Australian market didn't suffer as much as the European market did in terms of the impact on traffic growth. But tellingly, in the Australian market, the last 4 toll roads have all gone into receivership, have all failed. And the sort of lesson that banks are drawing from there, I think, is that it's a lot more difficult to predict toll road traffic that you'd actually thought, particularly where you have a more complex road network. I'd even go so far as to say today that a toll road project in the Australian market would be completely unbankable. The developments in the UK infrastructure market are quite interesting. And I think the resurgence that we're seeing at the moment more has to do with the government actually taking a step back from the very active PPP market that they had before the global financial crisis, and having a rethink about it. There was a bit of a public backlash against the private sector seeing as profiteering or making undue profits or windfall gains as a result of changed financial markets and various other things going on. The UK market was also a very heavy user of this monoline wrapped debt that I'd described previously. It was actually a lot cheaper than bank financing. After the global financial crisis, when they went back to going to bank financing, it was a lot more expensive than what they'd got used to. So the reason for the government guaranteeing debt there, I think, is more of a drive to get better value for money and get the level of risk that banks are taking down, partially by rethinking how much risk you want to actually pass through to the private sector and how you structure the project, and also in terms of guaranteeing part of the debt, as Shamala explained in the recently closed Mersey Crossing project. I think the UK market could have carried on closing deals. That it stopped because of a non-availability of funding. I think it was a government pullback rather to try and get better value for money out of its funding. The American infrastructure market, as I've described, is as an embarrassment of riches. As I said, they've got a very sophisticated, very deep bond market. There's the tax-exempt bonds and TIFIA funding available. But when I speak to my colleagues in America, they actually explain that these markets are reasonably volatile. So there isn't a sort of one-size-fits-all solution here. When you're actually acting as a financial advisor on one of the projects in the American market, you're continually running a number of funding solutions and testing them on the latest developments in the market, the pricing that you can actually think you can achieve, speaking to your colleagues in the bond section who are very active in the market and are seeing what's actually happening. And the statistics in the second last bullet point that I got there, since 2010, the 24 projects that closed, banks have provided funding for 6 of those projects. 17 of them went into the bond market, and 2 of them were hybrids or combinations of bank and bond financing. So that's just a result of what was the most efficient source of funding when that project actually came to close. The Australian market I've described as the best is yet to come, because you've just had an election there. The new government is launching a massive privatization program, and what they're looking at doing is selling off a lot of the existing state-owned infrastructure to use the proceeds to recycle into developing new infrastructure. There's a massive privatization program they've actually in the process of launching, and what we're expecting to see is that towards the end of the period in office of the current government is that you'll see a much bigger step up in PPP projects as all of that funding starts to be invested again in the new projects. I don't see any change happening there with the short-dated mini-perm structures and refinancing risk. I think if all the players in that market have got comfortable with that, and I'm certainly personally not aware of a project defaulting as a result of not being able to raise the funding at a refinancing date. The state is also stepping in and helping with refinancing risk, for instance, allowing payment adjustments to be made at a refinancing date to take account of movements in the underlying interest rate, but not in the risk margin, which quite rightly is seen as something for the private sector to manage. And then turning to the Indian market, I think the concentration risk issue is actually coming. We've seen it building for some time. I think the slowdown in the Indian market was driven by a number of factors. I don't think it was one thing really driving it. I think part of it was the election cycle. I think also a lot of the easier projects to do, the sort of what they call 4-laning, where you've got an existing road and you turn it into a dual carriageway. You don't have the land acquisition problems that you would have with a new greenfield road. Not that India has the sort of land acquisition projects that you perhaps see in Indonesia, but it is something that can be slow and time consuming. There was also a bit of a problem, I think, in that the market actually got too aggressive, and Shamala also referred to some investors handing back projects. We actually saw some of our customers in India that were big players in infrastructure withdraw from bidding because they actually just felt that the bidding got too aggressive. And I think some of those bidders who were acting too aggressively then actually found that those projects were just not viable anymore and wanted to actually hand them back. Having said that, there are a number of challenges that and changes that will need to be made to the Indian market to bring in the major international banks. And I think the biggest issue that you really actually have there is that the availability road projects are actually called annuity road projects. And they're called annuity road projects because the state makes a fixed payment every year. Those underlying payments are not actually adjusted for inflation. So the project company has to take full inflation risk on its ongoing operating costs over a sort of 20-25 year period. So if inflation actually suddenly rises, all of these projects could actually be bankrupt. And I think that the National Highways Agency of India is going to have to build in structures to adjust, to allow for a portion of the availability payment to be indexed to underlying inflation, as we see in most other markets in the world. Another challenge there is that the Indian bank market doesn't have a common lending rate like LIBOR or Euribor. Each individual bank sets its own reference rate, and how everybody gets comfortable with that as the bank not manipulating it is that is a single reference rate that applies to all of its customers. So obviously, if it pushes that up too much, it can actually lose customers. But having said that, it does actually vary quite a lot between different banks. There's quite a disparity in the funding costs of the various banks in India. Local banks, regional banks can have a much higher funding cost than the major state-owned banks like State Bank of India. And there's a limited ability, a limited market for interest rate swaps. So um, one way that the authorities could actually get past this is by also allowing a portion of the availability payment to be indexed to movements in in the reference rate. Maybe they could choose an average of a couple of the main reference rates, or the Reserve Bank of India could actually start pushing the banks in the direction of actually starting to establish a common lending rate. Right, then lastly, looking at the African infrastructure market, I think the South African market is actually very different. It is probably more liquid and has a more sophisticated bank market than most of the rest of the country. But having said the rest of the continent, sorry. But having said that, you are starting to see the South African banks expanding more and more into the rest of Africa, and I think that's going to lead to a transfer of skills. And I think the banks that they are buying in the rest of Africa are going to get the support from their head offices, and they can bring the staff across to help with that. The South African market has banked very complex projects, and I think the most complex of those was the Gautrain Rapid Rail Link, um, a new rail link connecting the Oliver Tambo Airport to the capital Pretoria and the commercial capital Johannesburg. And I think the challenges that is going to stop the international banks going into the rest of Africa is more has to do with the perceived risks of the countries than the projects. You know, they do tend to have quite low ratings. Um, I just looked up the latest ratings earlier for Nigeria, which is the biggest economy in sub-Saharan Africa now, has got a double B minus rating, um, and Kenya's got a B plus rating. That is going to make it very difficult for international banks to go in there, particularly for longer dated funding. The structures that Shamala explained, I think those are going to be the norm of what you're going to see, typically what you're seeing on power projects, and I don't think it's something that is sustainable to a great extent. I think you can handle the governments can manage a few projects with payments linked to the US dollar exchange rate. But if you start getting too many of those, and then you do have a sudden collapse of currencies, as quite often you can see in periods of crises in Africa, you could actually end up that the sovereign couldn't actually support all of those guarantees. International banks also aren't going to be competitive in local currency funding. Typically, a payment mechanism that's going to be in the local currency is not going to be able to be support US dollar funding unless it's backed by those guarantees and indexation. And then there's still a concern about a lack of transparency and corruption in a number of African markets. But I think we're starting to see all of that change. I think Africa has made a lot of progress, and I think we're going to continue to see it improve. And I believe the best way for governments to actually really start developing and getting PPP projects going is actually establishing a pipeline and running a transparent process. And I think that will start bringing bringing the bidders and the international players in. Right, well, thank you. That's the presentation as I'd set it out to you. I'm happy to take any questions anybody may have.
Yeah, we see quite a number of questions here. Let's looking at the time, we have around 13 to 14 minutes. So let's take some of the questions which are very closely related to project financing. I see a question here from Sayed Ali Zaidi. He asks, in project financing, it is viability of the project structure, the business plan, and the forecast revenue that convince the lenders to provide financing. The lenders develop their financial model around the information available. Are there different considerations for bond financing and bank financing? Gavin.
Yes, there are slightly different considerations. Different investors in different groups do look at things differently. I think things that can concern bond financiers can be how tradable the paper might be. Certain banks, for instance, don't like to do certain financing, such as prison projects. But when you actually peel away those sort of nuances, I think the real underlying structures and risk levels and risk appetites are actually all very similar. And if you look, back at my presentation, at a sort of macro level, there's not a great deal of difference between the risks in the European, American, and Australian markets.
We have another question from Sayed Uddin from Bangladesh. He asks, is there any move towards going back to funded proposals in any market? I'm exploring this option in Bangladesh at the moment. Would you like to take that, Gavin?
I'm not sure what you mean by funded proposals, but different markets do have different approaches to the level of assurance they want to see in accompanying their bids. The European market generally, for a first round bid, would be happy with indicative letters from financiers and a sort of loosish term sheet of about a sort of 30-page document setting out the funding terms. The Australian market, on the other hand, the government insists on not fully documented, but very detailed documented term sheets, which will typically run over 100 pages, and full credit approval from all the funding.
Thank you. We had some questions which had come in advance, and one question was, is there any experience where pension funds are involved in PPP financing? I would say there's experience from Canada and Australia where pension funds have been involved in PPP financing. And especially in Canada, we see a lot of direct financing by pension funds. One example I can think of, it's quite old, really. It closed 3 years ago, a 30-year concession to build the Southwest Detention Centre in Ontario, in which the Ontario Pension Board had been one of the investors. We also have the example of the UK PPP Equity Pension Infrastructure Platform Limited Partnership Fund, where you see a lot of these investors like Pension Protection Fund, British Airways Pensions, Lloyd's TSB, and others. So these are examples where the pension funds are coming in. Gavin, would you like to talk about pension funds investing in infrastructure in Australia? Maybe a minute to answer that question. This question was from Lincoln Floor, one of my colleagues at the World Bank.
Yeah, look, I think that is a very good question, and pension funds are a much more obvious source of funding for infrastructure and PPP projects. The banks are not really an obvious source. Banks tend to play in much shorter dated funding. And with the new Basel III regulations coming in, it's getting more difficult for banks to provide long-dated funding. And I think what you're seeing in the Australian market is something that might actually start coming to the European market, that you'll see the banks pulling back from providing long-dated funding. Pensions obviously have a much longer investment horizon. They need to invest for the long term, so it makes a lot more sense for them to be investing in infrastructure and PPP projects. And I think that is a trend we're going to see developing as they start building up their expertise and start getting more and more comfortable with the asset class.
There's a question from Dhruva Sahai. You can look at the scroll down near the chat box. Formation of state-sponsored infrastructure financing guarantee institutions has typically preceded the creation of a credible pipeline of PPP projects, due to which these institutions have languished with underutilized capital. What can governments do to support the creation of bankable projects through effective use of these institutions to kickstart their project finance markets? Would you like to answer that, Gavin? We've actually talked a little bit about what can governments do to support, bankable projects, but maybe you could talk about some specific examples here.
Yeah, look, I think an important aspect of PPP projects is the due diligence that the banks actually do in terms of double checking all of the underlying viability of the project to make sure that their funding is safe. So I think from a government point of view, that's a valuable part of the process. You actually want banks to be taking a risk on the project and standing to lose some money, but that doesn't have to be for all the funding. And I think this is the trend we're seeing in Europe. That I mentioned the cession d'AI in France, and now the partial guarantees that the government is actually offering for debt in the UK, in countries where there isn't as liquid and developed bank markets as you're perhaps seeing in the developed world. That can be used as a means of supplementing the debt, so that you're not actually having to raise so much debt at risk.
There's a question from Nasta. Has there been any successful experience when Eurobonds were used for financing PPPs in developing countries? Is there any example that you can think of, Gavin?
Nothing that really springs to mind directly. Indirectly, I do know that the European Investment Bank, when they did put some rand-based funding into one of the toll road projects in South Africa, they actually did mandate a bank to do a back-to-back Euro-Rand bond. So it's effectively issuing a Rand-denominated bond into the European market. But the investors there were not taking a risk either on South Africa or on the project, although those funds were effectively being used by the European Investment Bank to invest into that project. Bond investors in Europe and probably in America as well are going to actually battle with the country ratings of a number of the emerging countries. As I mentioned, there is the high yield bond market in the US, which is used to taking perhaps bigger risks or risks on lower rated credits, but that's a very expensive market to approach. Right.
We have another question about Africa. We did discuss quite a bit about Africa and how the current structures backed by guarantees and power purchase agreements, offtake agreements are likely to continue. But we have a question here from Agirito Savadogo Tinto. Given the weaknesses of reluctance of local banks for risk taking and the high cost to leverage funds, do you have any alternative investment model for African countries based on the existing systems to help Africa use PPPs to close the infrastructure gap? Would you have anything to add beyond what you did discuss at the end of the of your presentation about the current structures continuing for some time and yet at the same time not being
Look,
sustainable,
I
looking at
think at the moment,
needs?
I think funding in the African market is going to continue to be dominated by for some time by the uh, development finance institutions that are prepared to take the sort of higher political risks and perhaps actually have more influence with governments. I know you talk about the umbrella effect. If you co-invest in a project alongside the IFC or the World Bank, you actually feel that the government is going to be think a lot more before it actually defaults on debt that involves those sort of institutions than just a European commercial bank, for example.
We have a number of questions. In fact, it's a repetitive. Yeah, it's been repeated several times. Can we focus a little bit on European markets, please? And how do you see the German PPP market, and how do you expect it to develop given the huge need for new infrastructure? Gavin, do you have something to say on the German PPP market? It's not really a market we think about much from our point of view, from the MDB point of view. But would you have something to say on that from the financiers point of view?
The we've it's the German market is quite a bit smaller than a number of other markets in Europe. I mean, if you think of the most active markets in Europe, you probably think of the UK, France, and Spain, and then some of the smaller countries have been quite active, such as Portugal and Ireland. The main projects we've seen out of Germany have actually been road projects. And what they've essentially been doing there on their sort of toll road projects is sort of securitizing the existing tolls that are being collected off the heavy goods vehicles. That's a sort of a structure that's unique to the German market. But they've also done some schools, I think some hospitals and some courthouses. But considering the size of the country and the German economy, not much at all.
We're coming to the end of our webinar, so unfortunately we can't. There are many more questions, but we'll not be able to answer all of these questions. Please do send us your questions. You have our email, and we'll try to answer as many of these questions as we can later on, following the close of the webinar. Finally, we've heard a lot from you, Gavin, on different markets. But finally, I'll ask you to highlight a few key issues for developing country governments which have been struggling to bring PPPs to the market and which are trying to look at ways to spur the market. So you have about a minute and tell us what are the key issues that government should be looking at and should be doing so that more projects come into the market.
Yeah, I think the most obvious thing that I think that governments can actually do is to start mobilizing their existing savings and getting their local banks to be more involved in supporting the infrastructure at home. So not just banks, any of the sort of financial institutions. Obviously, there's a great variety of emerging countries having different levels of access to local funding, but I think that is your cheapest, most efficient, and best source of funding for infrastructure.
Thank you so much, Gavin. Thank you for being with us today and taking time from your busy schedule. I know you have been, moving from country to country. We expected you in Hong Kong today, but we found you in Jakarta. Thank you so much. It was a privilege to have you with us. And I also thank the audience. We had a very tremendous audience with us. Thank you very much. And now we will have a short survey for you, a few questions. Please do answer these, and these will help us make the webinars more interesting, better, and we look to your feedback to continue to do this and to provide more interesting webinars for you. Thank you so much for being with us.